neutral strategies for futures options. This is a new one here. You are a pro on neutral strategies, Mike Butler, when it comes to the stock options world. You've been, slinging strangles, straddles, iron condors on Apple stock, spiders, and everything for a while. And maybe you could just fill us in on what we mean by a neutral strategy in any options market. What's a classic setup? What are we looking to neutralize, and what are we looking to make money on with our neutral strategies?
Yeah, so typically with neutral strategies, you're generally taking risk on both sides, and you're offsetting your delta exposure, which is how we ultimately define our directional exposure. So in the case of that short call spread in natural gas we were just looking at, that's going to be a short delta position. But if we took the other side and we sold a put spread at the same time at a similar positive delta, you've got two positions that are offsetting each other from a delta standpoint, and that creates this neutral range of profitability. So that applies to like the straddle that Frank was just filled in. And also if you have like an iron condor and oil, something like that, iron condors, strangles, straddles, any time where you're taking risk on both sides and those deltas neutralize each other, that's where you have yourself a neutral option strategy.
Very well said. And yeah, anyone who's looking at some neutral futures option setups in natural gas or, crude oil, or like we're looking at today, some Forex markets, be sure to reach out to me on Twitter at Frank_Caberna with any ideas. I love different ideas on these markets, or any questions around how you can translate some of your strangles or iron condors or what have you to futures options. And also make sure you hit up the Small Exchange YouTube with those questions and ideas and comments as well. But let's get into probably, this is the most aggressive neutral strategy, but in my head, it's the most basic. And especially for Forex markets that, even though they're volatile right now, aren't screaming off the page with high implied volatility. I mean, we're looking at natural gas has an implied volatility of 90%. The S&P 500 has a baseline volatility around 20%. And even though US dollar has been moving around a lot in the last month or so, implied volatility of 5 to 10%. And so I like looking at this aggressive strategy for this market in particular, but also it's really straightforward, right, Mikey? Like neutral strategy, I'm trying to offset my deltas. What easier way than just merely looking at the at-the-money put and the at-the-money call, shorting both of them? I'm short the 50 delta put. I'm short the 50 delta call. I've got zero deltas on, and I want the market to, well, what do I want the market to do? If I sell, for instance, the market's at 159, I sell the 159 call and the put here in SFX options.
Yeah, you basically want the underlying to stay near your short strike and not exceed the credit received. So what, like you just were filled up on a $2 straddle. So you've got $2 to the upside, $2 to the downside, to where you would have a scratch at expiration. But what's nice about this is that you start with a neutral delta, but if SFX sells off, you'll start to get a little bit more positive delta. If SFX starts to rally up to 160, 162, you'll get naturally a little bit of short delta. So without even doing anything, you have this kind of contrarian position that will ebb and flow with the market in both directions. So for people that like to have this kind of neutrality, but also have the ability to get short as it rallies and get long as it sells off, this is one of the most popular strategies for that reason.
Yeah, absolutely right. It is the greatest kind of like do nothing trade. I'm hoping that nothing happens. But if the market does, like Mike Butler says, I sold the 159 straddle for $2. My upside break even is 161. Well, guess what? If the market gets back to 161 or 162, those are the highs in US dollar for the last several years. Yeah, I want to be short there. If the market breaks down $2 or $3, I want to be probably picking up some long deltas. And so really nice to put on these neutral strategies. What's also really nice, especially in futures options, this is the case. You get credits for that straddle, Mike Butler, that are really close to 100%. And actually, we were just quoting this. It looks like some capital requirements for trading SFX options have come down recently. You're actually getting more than 100% for the current straddle in July for SFX options. Really nice potential returns here, not especially, but even if you are managing like we like to do for straddles at 25%, you're looking at almost matching that return on capital, and sometimes in some cases exceeding that 25%. Trying to take this thing off early, and why do we manage these straddles, whether it's stock options or futures options, for 25%? Why wouldn't I just take that thing all the way into expiration? I'm looking for 100%. I want the full $200. We manage these things at 25%, right?
Yeah. And really the reason why is because you should never expect this straddle to go to zero value, because you're always going to have one option that's in the money, whether it's the call option or the put option. One of them is always going to be in the money, and however much it is in the money is going to be your value at expiration. So that's why with straddles where we don't have any room, any out of the money room, which is contrary to like an iron condor or a strangle, where both of your strikes start out of the money. When you share the same strike, you should always expect that one of those strikes is going to be in the money and have intrinsic value even through expiration. So we want to limit our expectations because of that. But like we're talking about here, you can collect such a high extrinsic value when you sell those at the money strikes, because that's where the highest extrinsic value is anyways. And with such a high return on capital, even managing at 20-25% can get you 50% return on capital, which is, kind of unheard of in the equity space.
Yeah, a lot of research has been done on how greatly you can reduce your risk by managing neutral strategies like the short straddle or the short strangle or iron condor for 20, 30, 40, 50%. And it's also shown that can come out in, a week. You put on a 45-day trade, that can come out in a week or two, and then you can move on to something else, or, putting on a different strategy in the same market there. Now, if the market does move outside of those profit zones, and Mikey, this just happened to you recently, all you have to do is roll that straddle out in time. Maybe you sell it initially for $200 in credit. You roll it out in time, 1 month, you get an extra $50. You get an extra $50. The market comes down or gets close to your short strikes. You've been collecting credit that whole time, and you're still ending up looking for that nice 25% of your initial credit received, right? And you're still looking for profits at the end of the day, even after defense that is pretty simple, just rolling out that straddle in time.
Yeah. And I think the big key here is not increasing your profit potential if you're defensively rolling. So like you said, looking for that original profit target, like 50 cents on a $2 straddle here. But yeah, if you have the ability to keep rolling, and this is why trading small is so important, you can roll this thing perpetually. And right now I've got, if I rolled today for 50 cents, I'd have $2 and change in credit. If that becomes $3 or $4 on a 157 straddle, I'm basically protected all the way up to near the highs and all the way down to like 153, which becomes a huge range in a product with such low implied and realized volatility.
Absolutely right. And we hope that no one has to play defense. I hope your profits come pretty quickly. But if you are a community member, playing all that defense and doing all of the rolling trades and everything, going to be cheap and easy. 50% off fees for life for Small Exchange community members. If you haven't joined yet, go to community.thesmallexchange.com. Reduced fees for life on all futures and options from the exchange, and current promotion. You can keep track of all your trades in your handy dandy trader notebook. Small Exchange teaming up with Field Notes for some cool notebooks. I dropped some off at the Tasty Trade office for Mike Butler and the gang. Get yours by joining community.thesmallexchange.com. Reduced fees and trader notebook for life. Be a part of the community. And that's it, Mike Butler. That's all we got. Thanks so much for joining me. Make sure you're checking Mike Butler out elsewhere on the Tasty Trade Network. Follow him on Twitter and his great YouTube videos as well with the Tasty Trade YouTube channel. Everybody, thanks for watching. We'll be back with more small stakes tomorrow, but stay tuned for Splash into Futures with Pete Momack coming up next. Thanks. Peace.
Peace.